Welcome back to the Global View. I'm Nadine Blaney. So we're looking for ways to make money beyond necessarily ASX listed companies. Great to be here with you. Let's set the scene though. We saw US markets surging through the overnight period. Really strong performance, set up for a very strong weekly performance. Of course, we still do have US jobs data looming, but it is expected to be a pretty benign read. And we did see jobless claims rising just marginally overnight. That's not directly related with the non-farm payroll report, but there was also encouraging news in the US on the inflation front. A report from the Labor Department showed worker productivity grew at its quickest pace in 3 years in the third quarter, depressing labor costs. As I said, tonight's report expected to show a deceleration of job ads, a cool down in wage inflation, and an unemployment rate at 3.88%. So on that, and importantly, this notion that the US Fed has hit peak rates saw benchmark Treasury yields tumble to 3-week lows. Also, the Treasury Department announced a smaller than expected increase in longer dated Treasury supply, further removing some pressure on equities. Worthwhile noting the Bank of England did leave rates at a 15-year high, reinforcing its messaging that it will keep borrowing costs high for some time yet, saying it is too early to be thinking of rate cuts. The bank rate sits at 5.25%. It is the second pause in a row after 14 back-to-back rate increases. Governor Andrew Bailey says that inflation is still too high and that the BOE is determined to get it all the way back to its 2% target. So with that as the backdrop, where to now for equities? Where should you be allocating? Keeping in mind, there are still quite a few risks out there. Geopolitics comes to mind as well. Dave Sekera joining us from Morningstar. He's the U.S. Chief Market Strategist there. Looks like a lovely evening there. Thank you so much for sticking in the office to speak with us. Okay, this rally that we're seeing, I've been told a couple of times this morning that it's seasonal, that it's looking pretty good to rally to the end of the year. Obviously not every day, but what's your sense around it?
I mean, the seasonality certainly is going to help, but I think it's a lot more than that. And I think we have a pretty good setup for the next couple of months. And it's a couple of things. I mean, the market action yesterday afternoon, our time, after the Fed and pretty much all day today was really all about the Fed. And I think to some degree, the market is really just catching up to what our view has been for quite a while now. So we've been quite vocal since July that we thought that that was going to be, the last rate hike from the Fed. So we were not caught unsurprised, by this. And we've also been saying for the past couple of weeks that we've been expecting the Fed officials to start shifting their messaging to the markets. I mean, they've been very focused on inflation for the past, 12 to 18 months. That's really been everything that they've been talking about, only playing a little bit of lip service to, employment and jobs and the economy. But I think that, when we listen to, some of the commentary from, Fed Chair Powell, earlier this month, in a speech that he gave at the Economic Club in New York, as well as his body language here. I think they really are starting to make that shift, and I think we're going to hear more of that from some other Fed officials next week, and that will allow them in early 2024 to become ever more accommodative. And we're still on the record. We think that the Fed's going to start cutting rates in the first half of next year, just based on a combination of just the slowdown in the economy that we expect, as well as a continuation of moderating inflation.
Yeah, okay. So with all of that in mind, can we just briefly touch upon U.S. earnings season? Because
hmm
again, there's a pretty positive sentiment coming from that. Many have beat. But if you look at Apple,
hmm
if you look at Apple today, I mean, that's been a
Yeah.
disappointment, primarily because of China, is what I'm reading into it, and as well as the holiday sales
hmm
outlook. How damaging is that to sentiment?
Not probably as much as you would think. I mean, again, Apple is the largest company in the United States by market cap. So again, it's going to have, a skewed impact on market performance. But when I look at the performance today and I look at, those magnificent seven stocks, they weren't necessarily the leaders of the market. We saw much more broad, uptrend across the entire market than just those seven. So I think that's going to be a pretty good factor as well. When we look at, third quarter earnings, I mean, it was pretty easy for most companies, to easily, meet, if not beat expectations. People were surprised, ourselves included, and we're in the soft landing camp, just as how far and how much, the US GDP has held up. But again, we do think that GDP, will start falling. So looking at those magnificent seven stocks, I'd just say, kind of the takeaway here would be, we increased our fair value slightly on three of them, Amazon, Meta, and Microsoft. We left our fair value unchanged on Alphabet. We actually decreased our fair value slightly on Tesla, and right now I'm waiting to hear from my analyst as far as his takeaways for Apple. But I would note, coming into earnings, we thought that Apple was overvalued. Trades at about an 18% premium to our fair value.
Okay. Generally speaking, when you look across the
Mhm,
market, where are you seeing undervalued sectors that do have
mhm.
promise?
Yeah, so there's a couple of different areas. So first, I would note, that even after the rally today, the market's at about a 9% discount to a composite of our fair values. And that puts us into, pretty undervalued territory. At that discount over the past 12 years, I mean, the market's only been at this low of a discount, only 18% of the time. So again, I do think that the market overall is pretty undervalued. We still think value stocks should be an overweight. Those are trading at about a 21% discount to our fair value. Core or blend stocks, those are at only a 4% discount. So I think that's probably a good underweight for investors. And then growth stocks are at an 11% discount, in line with the broad market. So that would be an area that I would market weight. But there are, a lot of changes that we've seen in, some of the different sectors. And that's where we're finding, a lot of individual stock opportunities today.
Okay. Like what?
First one is going to be utilities. So again, the boring utility stocks, they just really got hammered in the U.S. in August and September. And in fact, not only did they fell more than equivalent long-term dated bonds. And so what we're now seeing is that they're trading at the greatest discount, that we've seen over the past decade to our fair values. Yet the underlying fundamentals are as strong as ever. So I think with interest rates having gone up, people were selling these, but we think that they just got to be, oversold. Yeah, a couple stocks that we'd highlight as some of our picks right now would be Entergy. It's a five-star rated stock. 5 stars is our highest rating. Trades at a 21% discount to our fair value. Provides a 4.5% dividend yield. That would be the one my team says they just think has the best combination of growth, value, and yield. The next one would be Next Era Energy. Now, granted, it only pays a 3.25% dividend yield, but that one trades at a 30% discount to our fair value, something that we rarely ever see, in the utility sector. And then the last one I'd highlight is going to be Duke Energy, a nice large cap name in that space, 4-star rated stock, trades at a 14% discount and pays a 4.6% dividend yield.
Just looking at those beautiful buildings behind you, Dave, makes me wonder about real estate. You
hmm
know, if we have hit peak rates and it's been a beleaguered sector in many cases,
hmm
are you seeing value there?
We see a lot of value there. In fact, real estate is the most undervalued sector across our coverage right now. The sector itself is trading at a 25% discount to fair value. Now, personally, I would still steer clear of urban office space. I think that, it's still really muddy as far as what the valuations there should be. So I do think there's still more risk to the downside. But there's a couple of different areas our team has highlighted. So one, just more of those defensive areas within real estate like healthcare. I think there are a lot of opportunities. Our pick there is Ventas. It's a 5-star rated stock. Trades at a 40% discount, pays a 4.3% dividend yield. We're also looking for where we see improving characteristics. So, for example, in the retail area, we're still positive on the Class A malls. We're still seeing foot traffic returning to the malls. The malls have become a lot more experiential. They're not necessarily as reliant on just retail sales. Our pick there is Simon Property Group. It's a 4-star rated stock, trades at a 30% discount, pays a 7.2% dividend yield. And then some of the other areas where, again, I think American Towers, which is a cell tower REIT, very tied to interest rates, but got pushed down, way too far. They reported pretty good earnings, for the third quarter, increased their guidance. It's a 4-star rated stock, trades at a 23% discount and a 3.8% dividend yield.
Yeah, that's impressive. Okay, just I know I'm pushing the friendship, but one thought on yields. It's like no equity
hmm
investor cannot have a view on yields or even these days fixed income.
hmm
Like, are you guys, allocating or recommending any allocation towards fixed income?
Yeah, I think within your fixed income portfolio now is actually a really good time, and we've been advocating this for several weeks now, that you should be lengthening the duration of your portfolio. Locking in still, we're not near the 5% rate anymore that we were, just a couple of weeks ago. But I do think even at the current 10-year, It's going to be a place where you're going to be pretty happy if you lock in some of these higher rates. I know our US economics team, we're looking for, the Fed to start cutting rates in the first half of next year. So those people that are hiding in those short-term rates will start seeing those rates, going down. But we expect actually the entire yield curve in the US to come down next year. I know our team is looking for about a 3.25%, by the end of next year on the 10-year.
Okay, look, Dave, that was a great chat. You covered a lot of ground. I really appreciate it. Have a really
Well,
nice
thank you.
autumn evening there in New York. Appreciate it. Dave Sekera there joining us from Morningstar. Really clear, really easy to understand. We'll get that up online for you shortly. One final check on where the local market is set to trade upon the open. Looking like it's going to be a pretty good day here in Australia. And here's some food for thought. I found this on the Daily Shot. Check it out. Companies with the highest R&D spending. Look how far ahead Amazon is. So when you're thinking about what comes next, when you're thinking where the growth is going to come from, does it come from the company that's investing the most? I can't answer that question, but it is something that I just thought was a really stark picture as to where a lot of that spend is going. And this is global. This is in 2022. Okay, after the Apple results earlier, we've got lots of people looking towards how all of these tech companies will perform here locally. Also in focus, Macquarie and Qantas. Stay with us.